Hey everybody, hope you're doing great today. In this video I'm going to talk about the insane market that's going on with multifamilies. Now, with the Federal Reserve holding rates for close to zero for a number of years, a lot of people went out on the risk curve. Basically, they were looking for yield, they were looking for return, so they decided, hey, let's go look at other alternatives. So things like commercial real estate, multifamily real estate, investing in stocks, investing in bonds became the latest craze. High-risk stocks, whether it's AMC or GameStop, were bid up to insane numbers based on the feeling that, okay, this is a good investment and we'll YOLO our money into becoming very rich. Now, we see how that turned out with a lot of the stocks, especially these high-flying meme stocks. They're now back to lows. Some of the meme stocks still continue to run. That means there's still money out there. Also gives point to the Federal Reserve that raising rates and our quantitative tightening, basically withdrawing money out of the market, is not done yet. We still have more to go. We still have more room to go. Signs of a recession are still well off. Economy's humming along fine. People are buying cars. People are buying electronics, going on vacations like there's no tomorrow. So the fact that this money is still getting thrown around the economy, still getting spent in the economy, we haven't seen much signs of a slowdown, still gives room for the Federal Reserve to raise their rates if they need to, especially if inflation does not come down. As mentioned previously, inflation has come down. That's based on the base effect. Basically, the month-over-month rates have started to decrease, and even the yearly rate has come down because a year ago was high relative to, it's still high today. Even if it drops a little bit, it looks like it's a big drop compared to the high we had last year, where in some months we were at a 9% inflation rate. So rents have not come down in many markets. Rents are still going up. A lot of these large single-family home rental companies are reporting increasing rents month over month. A lot of multifamily investors are reporting the same as well. They're still able to increase rents, and they're facing little resistance from the tenants. The situation will change when tenants can no longer afford the rent increases, and landlords are forced to increase the rents because the taxes are still going up, insurance has gone up quite a bit, and they're not able to recover the money that they need to pay monthly loan payments, as well as to pay the operating expenses and maintenance costs for running that building. So here we can see the first signs of trouble are already appearing. In Houston, an apartment owner lost 3,200 units to foreclosure. They could not afford to keep the building, so they basically gave the keys back to the lender, said we can't afford it anymore. With increasing interest rates, especially those multifamily investors who used short-term variable rates or did not lock in the rates for long terms, are now facing higher interest rates. And so if they do need to refinance, and the fact that the federal funds reserve rate is above 5% means they're going to be facing much higher rates in order to refinance that debt. And if they're not making the cash flow, if they're not getting the money out of their existing tenants, and they can't raise the rents, that leaves them a big problem with negative cash flow, and that negative cash flow is just going to eventually eat away any investment that they did put into the building. So some investors are now walking away from their investments, as exampled here with this Houston apartment owner. From the St. Louis Federal Reserve website that keeps a lot of data and statistics, we're looking at here the owner equivalent rent. Basically, if you own a house, what would be the equivalent rent? And that's a self-reported number, usually done by a survey. But as you can see here, this number has been going up. So the rent rates are going up, and that justifies those who actually own buildings or own homes to be able to increase their rents. And they're not facing any resistance from tenants. Tenants are still able to maintain full employment. We haven't really hit a situation where there's a lot of layoffs or there's a recession and there's no longer as many job openings as they are currently. Here's the earnings call for the first quarter from American Homes for Rent. Their company set up to purchase single-family homes and rent them out to tenants. So the first quarter, the average occupancy percent was 97.2%, so they're almost at 100% occupancy. And they're reporting that there was a 30 basis improvement over the fourth quarter of 2022, so their occupancy has increased. Rental rate growth they report for the first 3 months, January, February, March, 7.8%, 6.8%, and 7.1% respectively. So each of those months they've been able to increase rents by around 7%. Invitation Homes, another company that primarily focuses on single-family home rentals, also reported in their recent quarter one earnings report that new lease rent growth has accelerated sequentially every month so far this year. So this is for the year 2023. So rents are going up in different markets. Let's take a look at some of the tweets from Multifamily Madness, a Twitter user who reports on multifamily as an investment and provides their perspective. A lot of large multifamily buildings are purchased through the use of syndication agreements. Basically, there's a general partner who leads the syndication agreement. They manage everything, they bring together the team, and then there are limited partners who bring capital mainly to the table. In return for bringing that capital, the limited partners are expecting high rates of return. As mentioned before, they're looking for a return on their investment, especially when the Federal Reserve interest rates were low. There were a lot of low interest rates on risk-free assets such as government bonds, CDs, and your money market funds. But now that has turned around, the rates are higher. You can get government bonds in the 5% range. You can get CDs in the 5% range. So there is less desire from a lot of these limited partners to invest in higher risk multifamily buildings and commercial real estate buildings. So some of that capital will be drying up here shortly. So in this thread from Multifamily Madness, they mention syndication slaughter is coming. Here are a few reasons why some operators will get obliterated and lose a lot in the next 6 to 18 months. They mention operator error. A lot of these operators did not know how to underwrite, asset manage, account, or operate. They also have a full-time day job in hopes of getting a good return. They don't necessarily have the skill set to properly manage a large multifamily building. Multifamily Madness mentions that a lot of these operators had no business taking money from investors. Multifamily Madness also mentions that debt on these properties, when they were taken with low rates, that also resulted in the cap rates on these multifamily properties going down. So a lot of these investors used high leverage positions, which means as rates go up, they're going to be upside down on their investments. Basically, they owe more than the property is worth. They also note that a lot of investors took floating rates. So rather than getting a fixed rate for 5-7 years, they decided to go with a 2-3 year floating interest rate. And a lot of those purchases made in 2020, 2021, and 2022 will be facing the situation where they need to refinance within the next year, and they're going to be refinancing at much higher rates as noted before, and that's going to cause quite a few headaches. As a result of COVID and all the inflation we've been seeing, not only have taxes gone up, but insurance rates are also going up, and that's going to put further pressure on these multifamily operators, which is going to cause them to try and increase rent. They can only increase so much. If we do get into a recession, that's actually going to go backwards. Instead, rents will have to come down. As more tenants move out, the vacancy rate increases. Multifamily here also notes that a lot of these operators didn't know where they're buying. There's a large multifamily complex. We want to buy that, but they didn't necessarily research the neighborhoods to figure out, okay, is this a good neighborhood to invest in? If they decide to increase the rents by increasing the quality of the units, will that local market support those rents? In some cases, these investors did not do that research. They figured, okay, the rents will follow if we improve the quality of the units, but the local area where these buildings are situated, the local tenants would not be able to afford those rents. Multifamily Madness talks about these apartment owners in Houston that basically they made the purchase, but they didn't do any value add. By failing to do any value add to these buildings, you're not increasing the value of the buildings. And as time goes on, as tenant wear and tear goes on, the building value go down. That also ended up hurting these investors. There's a lot of other investors out there like that as well too. A lot of these investments were underwrote using pretty high rent growth rates, and the numbers pencil out that way. And as so long as rents are going up, that does help them keep afloat. But as soon as we hit any bumps in the road, whether it be large-scale layoffs or a recession, which results in large-scale layoffs, as well as lack of new job opening, that's going to cause a lot of problems for these operators. So basically, there's a lot of leverage built in the system with regards to multifamily investments. And there are many investors out there who did not necessarily have the skill set to take on these investments, but the money was easy, the money was free, and a lot of the limited partners who had the cash, who were ready to give these towards these syndication agreements. So some of these investors now are facing capital calls. Basically, the general partner is running short on money, so they're going back to the limited partners and saying, hey, we need more money in order to keep going. Limited partners are only willing to do that for so long. After a while, they're going to be like, okay, we're putting good money after bad. It's time to pull the plug. And a lot of these syndication agreements and multifamily operators will be forced into bankruptcy. And then as these buildings go back to the market, depending on who's managing them, who's maintaining them, their condition might degrade over time as well too. So we're still at the early phases of this, so it's important to keep an eye out on these things. Right now, we don't know necessarily what's going to trigger a full-on recession. There's a number of factors: commercial real estate, mortgage-backed securities, multifamily issues, the job market, labor market, and any geopolitical issues, such as the war in Ukraine, as well as the potential war in Taiwan. Please add your thoughts in the comment section below. Let me know, are you seeing any issues with local multifamily investments? What kind of issues are you seeing? Are investors still chasing deals, or are the deals just sitting there waiting for somebody to make an offer? Thank you for watching, and I'll see you in the next video.